Are you wondering how do stock charts work or how do you read a stock chart? In this video, I'm going to show you how to read a stock chart and tell you why it's so important for investors to be able to read stock charts. And really, we're talking about just using stock charts, taking a quick glance at a stock chart before you purchase an asset, any investment that you're making, so that you can get a really great overall visual for where the price is of that investment relative to where it's been in the past. Hi, I'm Camille Gaines here, and on my website retirecertain.com I write about and talk about investing for the past 40 years or so, along with creating multiple income streams after an unplanned early retirement. This video is going to step you through beginner level, really, stock chart reading, because once you learn this, it's going to open up a whole new insight into investing in anything that you're thinking about buying, and even any investments that you already own. You can just pull up a quick chart and see how the price of your investments, how they are now relative to where they've been in the past. And this is super, super important. If you like this type of information, subscribe to my channel below so that you know when I post new videos, but you've got to click that little bell in order to find that out. Okay, so I've already got a stock chart open here. And what I want to show you is, first of all, over here on the right-hand side, and I want to just mention this is Street Smart Edge from Schwab. And I want to give them credit for this. I don't have any sort of affiliation whatsoever with Schwab. I just happen to use them for some of my investing. Okay, so over here on the right-hand side, don't be intimidated, okay? We have pricing, and over here on the bottom, we have volume, okay? No big deal, right? It seems kind of intimidating when you look at this, but we can see over here, here's the price, here's the time frame, okay? And I'm going to just sort of show you the basics here of how to read a stock chart, and then I'll step you through why this is so important and the huge insights that you can get as an investor from doing this, from looking at a stock chart, from learning just the very basics of how to use and read a stock chart. Okay, so let's see. I'll start by telling you what I've got open here is the SPY, which, as you've heard in my other videos, you'll see right there, SPY, and that's the Spider S&P 500 index. And you probably already know if you're watching my channel, but if you don't, that's an index that represents the overall stock market in the US. And it's a little specialized in that it's large company growth stock, so it's probably not the absolute best for the overall market representation. But let's just think of it in that it represents large US companies and as far as the stock market goes, okay? And I've got other videos on explaining the index more that you can watch on that. What I want to show you here, and I'm going to show you a couple of different indexes or indices, as some people call them. And what I want to show you here is the importance of this. Now, I'll start with showing you here. I've opened up the max chart right here. And this is, let's see here, it's 2002. It's March of 2002, okay? And then we're going all the way up here to the very end of 2021, all right? So this shows that stretch of time. If you had invested in SPY, which is that fund representing, or that index representing the US stock market, it would have risen from around down here. The price shown here is about 108 all the way up to here, okay, 474. Now, we don't want to get too caught up in this, but I just want to say this has been adjusted for various things. If you look at a stock, an individual stock, for example, it would have been adjusted for stock splits and that type of thing. So SPY is just the index. So here it is, the price movement of it. And these little D's on here are the dividends that were paid out from the SPY index. Okay, so what I want to show you, well, one thing I want to mention here, it's a little deceiving because you have to say, okay, well, what happened prior to this? And I want to say that the SPY was a lot higher than this, okay? It had fallen because remember we had that big bull market of the 1990s, and then it fell and it came down here, okay? And then, so it's a little deceiving on how it looks because it had been up here and then it fell. And so it happens to start here in 2002, and that was the tech bust bear market going on at that time frame, all right? And then what we can see from this is we had a lot of ups and downs in here, and these look really small, but what if we do this? And I can just drag this and show you. And remember, it had been way higher than this before 2002. Stocks had been way higher. And so it came down, and then it hung around down here, up and down, up and down, up and down. And just to give you a time perspective, again, this is early 2002 in quarter 1 around March. And then here we go over here when it got back to, well, almost break even or right at break even. This is February 2004, so about 2 years later. And what happens a lot with the market is it gets back up to where it was before, and it can't quite break through that prior level. And you'll see that that's what happened here. Sure enough, it bounced around for a little while, and then finally it broke out, what is this, in late 2004, okay? So we can look at any time frame with a good stock platform, and Street Smart Edge has a very good stock platform. Most brokers do. Some are more advanced than others, which I won't go into. But having said that, now you already know the basics of how to read a stock chart. It's price over here, it's time on the bottom. That's kind of all there is to it. And the price is plotted along here. Now, of course, you can get really super advanced here. And that's what technicians do with market analysts do this with technical analysis. That's not what we're going to do. We're going to say, hey, I've got a diversified portfolio of stocks, or you may even own SPY in your 401k or other type of retirement fund. A lot of financial advisors buy index funds for their clients, or they buy a basket of stocks, a large group of stocks that really sort of mimics SPY. It performs really similar to SPY. So this is a good way to check and see sort of where your investments are relative to the past. Now let's make this more recent. I'm just going to drag that bar over, and here we go. I want to just point out before I go all the way over there is, let's take a look at, this is the first decade, and we're leaving out, remember, early 2000s when it was higher, of the 2000s. And this is 2007. And then here was the bear market of 2007 through to early 2009, through about March of 2009. And you'll see the beating that stocks took, and then they eventually recovered. So you can look at any time frame like that. Now let's see what's happened lately. So if we look at big picture perspective, we've got over here the tech bust, we've got the financial crisis, bear markets, and then we came on up, and then we had these two little bear markets that sort of just barely qualified for bear markets, particularly here. And then we had a little bit worse bear market, but it was really short and not a bad bear market, as you can see when we look at those relative to this. So some investors think that because they invested through this and bought on the dip, it was smart, and in hindsight it probably was, but it wasn't a secular, long, serious type of bear market that lasts for a longer time and drops more. All right, so I promised I'd bring you up to where we are now, and make sure you stay tuned to the end because I'm going to pull this back to these major 3 points I want to tell you as an individual investor. This was 2000, the exact date on this, we can look right up here. And oops, I moved my cursor. February 2020, okay, no surprise there. And then here we've been since then, okay? So if we just look, we can see, okay, well, we've had a really, really good move off the bottom since that low was hit around, let's see, that is March of 2020, okay. Now, let me show you really quickly first. I'm going to go to QQQ, and all I have to do is just type in QQQ is an index also, and it holds more technology type of companies. So when you see a stock that has a symbol with 4 letters in it, that is usually the QQQ. Here's the QQQ, and what's interesting about the QQQ, or the NASDAQ, I'm just going to say, is it took a lot more of a beating in the tech bust early 2000s because the stocks are newer. They're not as blue chip as the stocks in the S&P 500. Even though there's some huge companies in the NASDAQ now, they are not as likely to pay dividends. They're a little bit higher growth, or probably considerably higher growth companies than represented in SPY. And so this is the QQQ, and you can look at any index you want to on here, but those are the main ones. Now, let me just for fun pull up Tesla, because that's a favorite of everybody. I get clients that have positions in Tesla that really love Tesla because, well, it's made them a lot of money. And look how crazy this is and how different this is from SPY and QQQ, right? It's so different. It sort of went sideways here, and then it went up, and then it went sideways here, and then it went up, and now here it is in recent years. Now, why does all of this matter? Well, if you own Tesla, or really any stock, I'm not a Tesla expert, so I want to go back to really the index, because what I like to do is I like broad markets, and I like broad trends and investing around what's happening in the overall economy versus focusing so much on individual stocks at this point in my life. And so the things that I want to point out, I mentioned those super important things for investors to be able to take away, is number one, they can see where their stock is relative to where it's been in the past. Well, how is this helpful? Well, it's not, and let me back up and say it's probably not so much where their stock is, but where the overall market is. Because what happens is investors think, oh, if I pick the right stock, if I pick the Tesla, if I pick the Apple years ago, if I pick the right stocks or find the right financial advisor that picks the right stocks, or the right fund that picks the right stocks, I'm going to get rich from stocks. In actual fact, most stocks move with the overall stock market, and most portfolios of stocks really closely mimic one of the index funds or the indexes that you're seeing here. So it's really important for that reason to have an idea of where the overall market is when you invest in stocks. Okay, so that's number one, is it shows you where prices are relative to where they've been in the past. And that is super valuable information, because if you were retiring here and you had 80% of your money in the stock market, and then you went through this, well, that would really be a bummer, especially if you were planning on making retirement withdrawals during that time, because you wouldn't have capital gains unless you happen to be invested in some of the few stocks that went up during this bear market. And so it's important to use this information in conjunction with what your investment planning, your retirement planning is. All right. And then the next really important thing here is that you can see overall the stock market goes up, and that's fantastic. Over long periods of time, it goes up. I had a big paper chart that I got from Value Line Investment Survey back in my office when I first started investing in stocks decades ago. And it reminded me that stocks go up. I was younger then and I was less concerned about the market volatility. You can see that stocks do go up over long periods of time. Point number 3 is the time with which you enter the market has a huge effect on whether or not your investments will grow. The time frame that you enter the market, say for example, if you're investing from here to here, or if you retired back here in early 2000 when it was much higher than you can see on here, then for the next 10 years you would have had a negative overall return from stocks. It was almost 1%, but if you took out the dividends, which a lot of retirees do, it would have been a negative almost 3%, about 2.92%. I've got another video on that if you want to see it. However, if you had retired here and put all your money in stocks, although people were extremely fearful to do so, make sure you check out my video, Investor Emotions, where I explain these cycles and how we tend to invest around these cycles. If you had invested back here, it would have been fantastic. You would have had a great move. So you can see from this the time you invest and the length of time that you invest are huge factors in whether or not you make money in the stock market. And while you may pick an individual stock or portfolio of individual stocks that moves counter to this, it's unlikely. Most stocks are influenced by the overall market, and that's because the overall market is influenced by factors like the economy, and it's usually the economy that influences the markets, whether they're moving up, which is a bull market, or moving down, which is a bear market. Sometimes it's something else, a crisis, a black swan, which is an unexpected event, but usually it's the overall economy that drives the market, because when the economy is expanding, everyone wants to buy stocks, their companies are profitable, and when it's slowing down, investors want to sell their stocks because companies lose money when the economy contracts. Of course, there are exceptions to everything I'm saying here. I just want to give you an overall picture of how to read a stock chart, how the stock charts work, or explain that so you can take a quick picture, just get a quick visual to see how your investment has performed recently and use that information to make good investing decisions. Above all, remember, retire certain.